The wealthiest 1% in the United Kingdom hold more financial assets than the bottom 70% combined. That is not the interesting part. The interesting part is how they hold it. Not in complicated structures. Not in instruments that require a Bloomberg terminal to understand. The data is consistent, decade over decade. The more financial products a household owns, the worse the risk-adjusted outcome. More complexity. More drag. So why is the entire financial content industry, the courses, the newsletters, the YouTube channels, pointing you in precisely the opposite direction? Here is what the mainstream narrative tells retail investors right now. Diversify across 14 asset classes, hedge currency exposure, rebalance quarterly, follow factor investing, allocate to alternatives, layer in crypto as a volatility hedge. That is the advertised framework. Here's what institutional endowments, the ones managing Harvard, Yale, Oxford, quietly did over the last decade. They reduced portfolio complexity. The Yale endowment model, once celebrated for its alternative asset innovation, has been trimmed. The reason cited internally by multiple endowment managers was the same. Operational drag from complexity was eating net returns. Let that sit. The institutions with the most access to complex instruments are the ones choosing to step away from them. Now here is the data point that retail investors almost never see. A Vanguard internal analysis, cited by the Financial Times but never given a headline, found that the average U.S. retail investor underperformed a simple two-fund portfolio by 1.4% annually. Not because of bad stock picks, because of behavioral drag from portfolio complexity. Too many decisions, too many inputs, too many products generating too many cognitive load events per year. The industry does not have an incentive to tell you that. Because simple is free. Complicated pays commissions. Most people who come to personal finance content believe their core problem is a knowledge gap. They think they do not know enough about options, enough about tax-advantaged accounts, enough about emerging market allocation. And the industry is perfectly happy to keep selling them that framing. But here is what the research actually shows. And this is the part most investors fundamentally misunderstand. A study published in the Journal of Financial Economics tracked 66,000 retail brokerage accounts over 7 years. The accounts with the highest number of holdings had the lowest net returns, not because the assets were bad, but because the investors made more decisions. More decisions meant more errors. More errors meant more drag. The correlation was statistically significant and directionally consistent across income brackets, age groups, and geographies. The problem was never information. The problem was architecture. And the architecture most people are building, without knowing it, is designed to fail them slowly, quietly, and in a way that never gets attributed to its real cause. The 5 rules. Rule 1. The first rule is not about asset selection. It is about comprehension threshold. You should only hold financial instruments you can fully explain under duress to someone intelligent who is not in finance. That sounds simple. It is not. Because the financial system, particularly in the post-2008 environment, has produced an enormous catalog of instruments where the surface level pitch is clean. This gives you bond-like stability with equity-like upside. But the underlying mechanics are complex, opaque, and asymmetrically risky. Structured products. Leveraged ETFs, covered call income funds, reverse convertibles, buffer ETFs. Each of these has a clean brochure. Each of them has a mechanism that, under specific market conditions, will behave in ways the brochure did not emphasize. The principle here is not anti-sophistication. It is anti-opacity. There is a meaningful structural difference between complexity you understand and complexity you have been sold. The wealthiest private clients at the largest wealth management firms, not the institutions, the ultra-high net worth individuals, have one thing in common in their core portfolios: a small number of instruments they can describe from first principles. Everything else is peripheral, supplementary, not core. If you cannot explain how your largest holding generates its return in 4 sentences, that is a structural risk in your portfolio, not because the asset is bad, but because you cannot correctly anticipate its behavior in a stress scenario. Rule 2. There is a cognitive error that sits at the foundation of almost every retail investor's financial system, and it is this: they confuse automating execution with removing decision-making. They set up direct debits, monthly contributions, automated rebalancing triggers, and they believe they have eliminated the friction. They have not. What they have actually done is compress all of that friction into a single recurring moment. The moment they review what the automation has done, where the emotional stakes are often higher, because now there is a statement, there is a number, and there is a feeling attached to it. The minimalist framework inverts this. The goal is not to automate what happens to your money. The goal is to automate how you think about what happens to your money. That means creating a decision protocol in advance. Before volatility. Before a crash. Before the moment when your emotions are most likely to override your architecture. You write down, explicitly, in a place you will find it, what conditions would cause me to exit this position? What is my rebalance threshold? What is the maximum drawdown I will tolerate before reviewing? This is what institutional managers call an investment policy statement. It is standard at every pension fund in the United Kingdom. It is almost completely absent from retail investor behavior. And here is the forward-looking risk if you do not have one. As markets become more volatile, and the structural drivers of volatility are not going away, the investor without a pre-committed decision protocol will make more reactive choices, at worse prices, with higher tax friction, and lower outcome certainty. Every year, you defer, this costs you compounding clarity. Rule 3. This is the rule that almost no retail content covers properly, and it is the one with the most asymmetric impact. The financial content ecosystem is almost entirely focused on the return side of the equation. Which assets, which sectors, which momentum signals. Because return optimization is exciting. It has a narrative. It has winners and losers. It generates watch time. Tax efficiency is boring. It has no ticker symbol. It does not trend. It does not have a hot take attached to it. But here is the non-negotiable arithmetic. In the United Kingdom, a basic rate taxpayer investing in a general investment account versus a stocks and shares ISA holding identical assets for 20 years ends up with a compounding gap that is not marginal. Depending on the year of analysis and asset mix, the ISA advantage compounds to between 18 and 34% of terminal wealth. Not return. Wealth. In the United States, the equivalent comparison, a taxable brokerage account versus a maxed Roth IRA and SA, produces the same structural gap, and that gap widens with every year Congress has not simplified the tax code, which it has not done since 1986. The minimalist investor does not optimize return first. They optimize the container first. Because a 7% return in the right account is structurally superior to an 11% return in the wrong one across a 30-year horizon. Most retail investors have never been told this clearly. Most retail content providers do not tell them, because wrapper optimization does not require ongoing content consumption. It is a one-time structural decision. It generates one video, not a series. We are at the halfway point of this framework, and I want to stop for a moment and be precise about what is at stake in the next section. What we have covered so far, comprehension threshold, decision protocols, container optimization, is the defensive architecture. The part that stops you losing ground to friction, tax, and behavioral error. What comes next is the asymmetric side. Because minimalism in finance is not just about protection. There is a specific structural opportunity that opens up and widens for investors who simplify. An opportunity that is invisible to investors still navigating complexity. And that opportunity is directly tied to where we are in the current macro cycle. If you leave now, you have the defensive framework. That is useful, but the offensive application, which is where the genuine asymmetry lives, is what the rest of this covers. Rule 4. There is a deeply ingrained assumption in modern retail investing, particularly among the 25 to 45 cohort who grew up in the era of zero interest rates, that inaction is always the enemy of return. That assumption is wrong, and in the current macro environment, it is expensively wrong. We are in a period of recalibrating rate expectations, compressing equity risk premia, and elevated dispersion between asset classes. In plain terms, the market is pricing assets with less consensus than it has in 15 years. That is not a crisis. That is an information opportunity, but only for investors who have the cognitive and financial capacity to wait. The minimalist investor, by definition, has fewer positions to manage, fewer decisions to make, and a pre-committed decision protocol. Which means their patience is not accidental. It is structurally enabled. The complex portfolio investor, by contrast, is receiving constant noise. Every position is generating a signal. Every signal demands a response. Their patience, if they have any, is being depleted daily by the cognitive cost of managing complexity. Cash, in a period of genuine uncertainty, is not a failure of conviction. It is a call option. And like all options, it has a defined expiry. The minimalist framework holds cash not as a permanent default, but as a deliberate tactical position, with cost, duration, and a trigger for deployment. Most retail investors hold cash as emotional residue from fear, which is the difference between an asset and an accident. Rule 5. Every bull market generates the same mythology. The investors who won did so because they found something no one else had found, the contrarian call. The overlooked sector. The early stage position. That mythology is not supported by data. An analysis of retail investor account returns over a 15-year period found that the highest returning third of retail investors did not outperform because they found better assets. They outperformed because they held their assets longer, in fewer accounts, with lower turnover. The asymmetric return in retail investing lives not in discovery. It lives in duration and restraint. Pension funds, endowments, and sovereign wealth funds, the largest pools of long-term capital on Earth, do not have an alpha edge from discovery. They have a structural edge from time horizon, low friction, and governance discipline. The retail investor who builds a minimalist architecture is replicating that edge. Not with billions, with behavior. Let us close the architecture. The minimalist financial system, not the concept, the actual operational structure, has 5 components. They are not exciting. They are not new. They are not going to trend anywhere. But applied consistently, the research suggests they outperform 80% of actively managed portfolios over a 20-year horizon. Component 1. A core portfolio of 2 to 4 instruments you can explain from first principles. Index funds, direct gilts or treasuries, or both. Nothing with a fee above 0.3% annually. Nothing with a lock-in period. Nothing you would not be comfortable holding through a 40% drawdown, because you understand exactly why you hold it. Component 2. All investments held in the most tax-efficient wrapper available to you. ISA before general account in the UK. Roth and Shub before taxable brokerage in the US. This is not optional. This is the container before the contents. Component 3. A written investment policy statement, 1 page. No more. What you own, why you own it, under what conditions you will change it, and under what conditions you will not, regardless of what the market, the news, or your anxiety tells you. Component 4. Cash as a tactical position with a defined deployment trigger. Not an emergency fund that is separate. A deliberate allocation to optionality with a written condition for when it converts to investment. Component 5. A defined review cadence. Not daily, not when the market moves. Once per quarter. With a fixed agenda, duration. No more than 90 minutes. Anything that requires more attention than that is not minimalism, it is complexity wearing minimalism's clothing. We are in a macro environment that punishes complexity unusually hard. The era of synchronized global monetary policy is over. The period when buying any index in any account at any time and holding generated double-digit real returns is not the baseline anymore. The Federal Reserve and the Bank of England are navigating structurally higher neutral rates. Inflation is behaving differently than the pre-2020 models predicted. Equity valuations in the United States are, on a Shiller-Cape basis, in the 95th historical percentile. None of this means equities are wrong. None of this means you should exit risk assets. What it means is that the cognitive cost of navigating this environment for the complex portfolio investor is going to be disproportionately high over the next 5 to 7 years. Every macro input, every rates decision, every earnings season, every geopolitical development will generate a legitimate sounding reason to do something. The minimalist investor has already pre-answered most of those questions. The investment policy statement absorbs the noise. The pre-committed protocols handle the volatility. The low-friction architecture reduces the emotional surface area. The full assembled minimalist system does not outperform in every year. It outperforms across cycles. Because the cost of complexity is not always visible in a single quarter, but it is almost always visible across a decade. We started with a question. Why does the financial content ecosystem consistently steer retail investors toward complexity, when complexity, demonstrably, repeatedly, across multiple decades of data, degrades outcomes? The answer is not malicious. It is structural. Complexity generates dependency. Dependency generates recurring engagement. Recurring engagement generates revenue. That is not a conspiracy. That is an incentive architecture. And incentive architectures, more than any individual bad actor, are what shape the information environment you operate in. The minimalist framework is not anti-finance. It is not anti-investment. It is anti-friction. Anti-opacity. Anti the noise that gets sold as signal. 5 rules, 2 to 4 instruments maximum in your core. The right container before the right asset. A written policy that governs your decisions before your emotions do. Patience as a position. Duration as the real edge. None of this is complicated. That is precisely the point. The one question this analysis has not answered, and the one that will define the next decade of personal finance, is whether the structural shift currently underway in global interest rates will permanently alter the mathematics of passive indexing. Because if the 40-year tailwind of falling rates has genuinely reversed, the simple index and hold strategy may need one specific modification. That modification is not complex, but it is precise.